Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to LiveSquawk's Market Talk. This is the show that really brings you the latest sort of market news and events and discusses, what's been happening around the markets around the world to affect traders day in, day out, really. Welcome to the show then. Now, we're scheduled to preview today's US CPI report for March, and we will. However, yesterday afternoon, evening, depending on where you are, we had possibly one of the biggest market events of the last decade, I'd say, with some mad moves in all markets, really, but especially the risk assets and the US indices in particular. And we'll be discussing that with my guest today, Beat Nussbaumer, sorry, get the name out right. And we'll go over really just what's happened and the connotations for especially day traders out there more than anyone else. Before we get on that road then, just a quick disclaimer: the content provided on this channel is for informational and educational purposes only. I'm not a licensed financial advisor, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from the following the content on this channel. Now, I'll introduce Beat in a bit, but as I said, we want to look at the US CPI, and we will get on to the bigger elephant in the room, so to speak, as well. But we do have US CPI today, 12:30 GMT, 8:30 Eastern time, and we're expecting a softening of the March print, really, for both the headline and the core print. Year over year, seeing around 2.5, 2.6%. That's a consensus annually versus 2.8% previously. The core seen at 3% versus 3.1% last as well, again, dropping by a tenth. Just a note from Citi here. Citi research forecasts a modest 0.22% rise. Obviously, that's the unrounded number in the core CPI following February's 0.2% gain. They say we expect flat core goods prices, though with upside risks, and a 0.3% increase in core services, albeit with downside risks as well. Over the next 6 months, the inflation outlook will largely depend on whether stronger goods prices from tariffs are offset by weaker services inflation due to softer demand. It should be noted that on the LiveSquawk website, you can see a full preview. We have written a full preview for you there. That's titled March CPI Seen Cooling, but Trade Tensions Stir US Inflation Risks. I had to write this piece about 3 or 4 times throughout the course of yesterday as things changed every single time I put pen to paper. But it does cover the latest events that we've seen in the market and what happened yesterday evening. Just for those who want to know what happened yesterday evening, if you've been living under a rock, we did see President Trump announce on his Truth Social platform that he was suspending full tariffs for 90 days on all reciprocal trading partners except China. I mean, everyone but China would be taxed at 10%, but took the Asian nations' duties to 125%. This put markets in a spin, and we'll come to how that was delivered and what it did to the markets in a short bit. But as I said, we want to really look at today's inflation print, and at this point I want to bring in my guest, again, long-time contributor to the show. Beat, how you doing?
Hi Harry, thanks for having me.
No, pleasure, mate, always a pleasure. Right, we'll get the formalities out of the way first. We got inflation today. Does it really matter?
No. Let's put it this way. For me, in recent times, generally, even prior to this Liberation Day circus, before that, it would have been that data skewed to one side, which to me was weak is weak, meaning given we had like no cuts almost priced from the Fed for the year prior to all this tariff story, there was always just the risk that softer data would see a bigger reaction than stronger data. Now that may have sort of flipped a little bit. In regard to CPI today, I think it's the opposite. Strong would be strong, meaning if you were to get a beat on the data, so higher or stickier CPI, that would be pretty bad, given that we already expect incoming higher prices from potentially the tariffs, but also if you look at all the secondary data, prices paid, ISM, PMI, and so on and so forth, we already have higher prices in the pipeline that has not yet showed up in CPI. So there is upside risk for CPI in general. If we get a higher number, I think it would not be that good for risk, because we come into a situation where some tariffs will be here to stay. We kind of know that. So there is a small impact already there. So we get more sticky prices in the pipeline. A softer CPI, if people feel that, in the mood, there'll be some maybe risk bounces for an hour or two, but it's really irrelevant. I think there's a bigger, you called it an elephant. I hope you didn't mean Trump, but there's a big elephant in the room, which I think we want to talk next, I guess. But I think
yes,
CPI is not a really decider today.
No, fair point. And you look at what the Fed have said. We had the minutes out last night, if anyone noticed, and they kept that, that narrative that I think Powell put in when he spoke at the back end of last week about uncertainty. Really, I've got a piece here that I put into the preview. Participants generally saw increased downside risk to employment and economic growth, and upside risk to inflation, while indicating that high uncertainty surrounded their economic outlooks, according to the records of the last meeting. So generally speaking, the vibe really is, while this tariff fight is ongoing, it's really hard to sort of judge where monetary policies should be, and therefore for the Fed, they're likely to sit on their hands. And if that's their current stance, then from a market perspective, unless we see an outsized move in one direction or the other, really this shouldn't precipitate a large move in the markets. And as we've intimated several times, we'll come on to very shortly, there are bigger things at play at the moment that really demand more attention than a backward-looking March CPI print. However valuable it is as an insight into the state of the US economy, it really doesn't matter as much, I guess, as we said, as would normally be the case. And in terms of trading opportunities, there may well be one, but the likelihood is less so because of what happened last night. So just quickly on the breakdown here, as I said in my note, the banks are looking really, just trying to find the piece on what to look for here. Goods inflation. Here we are. Tariffs on China began at 10% rate in February and could begin to affect prices more directly as early as this month, according to analysts. Services prices should broadly moderate from the strength seen at the start of the year, including in categories such as recreation and communications. We also continue to forecast a more moderate pace for shelter inflation compared to recent years, with a 0.26% increase in primary rents and 0.3% rise in owners' equivalent rent. Now, I'm just trying to find out who. Yeah, Veronica Clark of City Research put that. She said, following a more modest 0.2% increase in core CPI in February, the bank expects an equally moderate 0.22% rise in March. In terms of the breakdown, I've got a table up here as well. You saw some hefty subcomponents really last month that may persist on the food side, at least anyway, and then the more variables in terms of energy and what that does. Hence why we take out energy and look more at the core to give us a steadier rate. But this isn't even the inflation gauge that the Fed looks at. The Fed looks at the PCE read more than this, deflator read, and more specifically than that, the core PCE deflator print as well, which takes out quite a lot of some of the variables there to give a steadier read. So that's out in a couple of weeks and will be of more attention to Fed officials than today's CPI is. So from that perspective, I guess it's a good trading opportunity in normal circumstances, but at the moment there are bigger fish to fry. And with that, we'll go on to what we saw last night. So, as I said, last night it was around 6:20 p.m. London time. Markets had a little hint that there might be something coming. Bessent was due to appear in front of a panel. He pulled out at the last minute, and we were told because he was in a meeting with Trump. And then I think it was about half an hour later, we got this from President Trump's Truth Social, so Trump Truth, as I like to call it. He said, based on the lack of respect that China has shown to the world's markets, I'm hereby raising the tariff charge to China by United States of America to 125%. That was the first headline that dropped. Everyone reacted to that, or maybe the algos reacted to that, and some traders. But the kicker was in near the end of the actual post, because this went on for a number of words and sentences. It says, and then he basically said at the end, I have authorized a 90-day pause and a substantially lowered reciprocal tariff during this period of 10%, also effective immediately. Thank you for your attention to this matter. And this is really what stirred the markets and got the equity markets moving upwards. And I think we saw general gains of between 8 to 10% for the major indices stateside. So huge moves that I haven't seen in long, not positive moves like this for many, many, many years. I don't think I've ever seen a move of some 9-10% in one go for an equity market or an index. So, Beat, what did you make of last night's event, and how do you trade this as an intraday trader, as someone who looks at not just from an investment perspective but from a trading perspective? How do you cope with this uncertainty?
Yeah, so let's quickly talk about yesterday, and then maybe a little bit in the broader picture of what's going on out there. I think yesterday, from a day trader point of view, or a kind of market professional point of view, I think it got sort of clear halfway through the day when we got the first news about the increase in tariffs for China, this 104% news that happened early in the day.
Sure.
Markets obviously sold off, risk effects sold off, equity sold off. But already then we didn't really break the lows that we previously had. And you could tell that, yes, while risk is selling off, it did not stay down. So there is always, and we had this in 2008, 2020, and so on, which we may talk a little bit about it later on, that there is a point in time where just too much has been sold. No matter what the news is, you just don't get that price any lower. And so this is where you really need to be more of an experienced trader to realize the price action, that when you get bad news and the market stops moving down, that just means enough is enough, and there is a sort of a big chance of a bounce. This is sort of, I got like small long risk on a few bits and pieces yesterday after I saw that, and the rest is just sheer luck that we got this 90-day story later on. But generally for day traders or traders that may not yet be that experienced, especially, this is even a big challenge for professionals to have volatility the way we see it. And you just got to first, hit and run trading. Don't try to be clever. Don't try to think too hard. Trade what's in front of you, whether you have a level on the chart, whether it's the news, whatever you use to trade. And the moment things start to go wrong, just cut. There's a famous saying that we always been singing on the trading desk: the first cut is the cheapest. And that is just in the current volatility, as you just expressed in this equity bounce, it's no different to FX, right? So you get like the 125% news, Aussie yen tanks, and then there is no offer to hit for a while when the 90-day story hits. So it's brutal in its sense. The moves
and it was even more brutal last night because, as you said, the wires led as you can, because these aren't scheduled events when he comes out and says stuff. So you can only read as fast as you can read, and so everyone would have seen that first sentence where he puts the tariffs on, ups the tariffs on China, and like you say, we'd seen this early in the day, and it was just like, well, okay, fine, but they're already getting hit rather hard. So would you necessarily react? Maybe some of the algos did, which is why we saw
algos would have reaction. Done. Yes, some will, trading desks probably have reacted, because that would have been just the next leg of risk off, just to run into like the biggest risk on news that it can get. And so this is where I sort of try to go. There's a few bits and pieces now, except for the sheer volatility yesterday. You either been lucky or unlucky. There's just no other way, and that just means you got to have. If markets are as volatile as they are, you have to cut your risk. Because why? Because you don't need a lot of risk. Because the volatility is so high, you make the same amount of money. But if you don't cut your risk in high volatile markets, if you lose a heck of a lot. So the first thing you always do when volatility goes up, you reduce risk. The trade size should be smaller because there's no need to have big trade size. Yeah, unless obviously the pros that may understand what's happening. But as you pointed out, yesterday could have called up any pro when you get the bearish news first, and then 7 sentences later you get the biggest bullish news you could get.
Yeah, exactly.
So anyone could be tripping up on that one. But I think what I would like to also talk about is the broader picture. The broader picture, I think, is really the key issue here. To me personally, like I said to you earlier, I think Trump blinked last night. It was actually him starting to worry whether or not he needed a crash course from Besant first, or what happens if the bond market breaks. Maybe Besant told him that this is all going wrong. We all know the sort of conspiracy stories, what Trump is doing, put the tariffs up, get like the Fed to cut rates, 10-year yields go down, like have these sort of quick recession, blah, 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 refinance $9 trillion of debt that they need to refinance. And then you sort of go back on the stimulus side, and you have an upswing in the economy again, right in time for the midterm election. So whether that is true, all that stuff or not, who knows? The key is, and I think that's the biggest key, there's two things here. One is, I think, the moves are similar to 2008. And I think there were a lot of commentators out this week talking about 2008 to a crisis. And that is definitely true. The big difference on this one is, this is a man-made crisis. This is a one-man only crisis, which...
This is avoidable crisis.
Yes. First of all, it's avoidable. But second is, the problem is, we could be like in the biggest crisis moment as we were yesterday prior to this 90-day story, right? I mean, credit spreads blowing out. I mean, it really looked like rather very dangerous. And then one sentence, everything is over. You didn't have that in 2008 or 2020. So from a trading perspective, it's also very difficult. On the one second, you have the worst market that you could imagine. One thing I would want to say is, if these tariffs were to stay the way they were announced, I think we could go into a situation that is worse than 2008. Yes, I definitely think so. Why? Because I think there's something, and this is actually the second part I want to mention. I think there's something out there which we now see in the price action, that too much damage has been done. And there
reputational damage to US assets, assets.
Yes, and I think it goes beyond that. I think it started, and sorry, I have to go back 1 or 2 steps. It goes back to, it's okay to have a wake-up call for Europe on the political side, Ukraine and all that stuff. It's fine. I know Europe isn't always the best, but to throw them under the bus is wrong. So basically, after 80 years of alliance, the world suddenly starts to wonder whether the US is a reliable partner. Now we just talk politically, geopolitically. So there is the first question. Then comes all this tariff stuff. So basically, allies or friends get like thrown under the bus also economically. So you create a real very strange scenario where actually even people that are in love with the US actually start to wonder. And I put my hand up, I'm one of them. Because I think there have been things happening. We know Trump is a bully, but even for his standards, he overstepped the mark large. And I think what we see now, and it will start in Asia, I think I have seen these flows for the last several weeks, where Eurodollars were bought in the market by Asian players that may well start to reposition themselves. And I'm not talking by any means, and no one should take this away from today's session. I'm not talking about that players start to panic sell US assets. That is not what I'm saying. But what I'm saying is, players start to reduce US assets investments. as they come due. Let's say China will not sell bonds because they're not stupid. They don't want to shoot in their own leg. They don't want
exactly.
to
They'll hurt themselves.
right? They hurt themselves. But if you have maturities coming up, it may well be that they start buying bonds instead, right? So I can see, and if you look at the price action in the dollar is still weak, right? We had this quick bounce and this hooray and whatever last night, but the euro just made fresh highs.
Yeah.
Dollar yen is back under pressure. 10-year is still 430, right? So it hasn't really, it has corrected a bit, but it's not really coming off. Equities are kind of under pressure again, which is clear after such a large move from yesterday. But there is this taste out there, which I think John Otis from Bloomberg made the point of, we didn't hit the real low for many months after the Lehman event, right? We had the big bounce and the big, QE and blah, 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 whatever you want to talk. But at the end, we still had a few months before we actually really bottomed out. And I think we're in a very similar position where, we had a tremendous rally yesterday. But let's not forget one thing, and this is what I try to remind also some of the people I spoke to from Bloomberg, Reuters, and so on and so forth. I think there's a big mistake of drawing conclusions from past crises. Why? Because the fact is the market has changed, right? In 2008, you didn't have as many algos as you have now, nor in all the previous crises, 9/11 or whatever else you want to bring up. So the game.
So we just said algos, for those unaware, algorithmic machines that basically, or programs that automatically can read headlines, can take in the data and press the button effectively faster than a trader can and react to to information. So
the volatility would never have been that big if humans had to create these moves yesterday, right? No chance, because we would still have had a very volatile day. But so when people talk about, it was a lot worse than this or that, that's because there is probably in certain sequences no humans actually involved, right?
Yeah.
So no wonder. And then you have the second thing which is liquidity. There was a story out from Reuters or Bloomberg last week that actually finally, thanks God, addressed the issue of foreign exchange liquidity. It's a $7 trillion turnover market a day, but the liquidity is actually not as deep as people always assumed. Why? Because we have this mirage liquidity. Again, the same price gets shown to 550 different algos, right? So of course there's no liquidity if things like yesterday happened. So it's a liquidity trap as well. But back to the original story, I think Trump did try to save face yesterday with increasing tariffs for China and give the 90-day story. So it didn't quite look as obvious that he was blinking. Bassett, who is a very intelligent man, if you looked at his speech yesterday, pathetic. Right? Even he tried to explain to us that we didn't understand tariffs, that tariffs was the peak. Yeah, but then don't introduce it. You could have done Liberation Day. This is what you expect, blah, 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 blah. 90 days grace period. If you don't negotiate, you get hit with the tariff. There was no.
You can tell he was told what to say. He was told what to say and how to say it, and it came across how it looked, and which wasn't great. And this is from a man, Besant, by the way, who's worked with George Soros, who was there in '92 and basically gameplayed the UK's response to the ERM and everything that happened there. So he's a very, very long time. He has vast amounts of market knowledge. Understands the game probably better than most people out there.
Yes. To be honest, I call him the only adult in the administration, right?
Sure.
So for him to come out like yesterday, I mean, I just felt sorry for the guy because he must
that's politics, though. That's politics.
Yes, exactly. Right. So where does this leave us? It leaves us that, so Trump wants, we will indeed have a 90-day pause on the tariffs. Some people, like the smaller countries, will have to just suck it up more or less because they're too small to fight, so they will do whatever is needed. I think the casualties from all this will be Navarro and Lutnick, maybe. I think those two guys are just the worst part of the U.S. administration. I think I won't repeat what Musk said about Navarro, but I would sign that.
The little gaps appearing in this in the regime now in terms of the infighting and the name
Yes.
calling in public, and that's not great for look. We're not a political show, but it's not great for confidence. It's not great.
No.
Again, it just chips away that veneer of the US. It's not untouchable, but being up there as a standard, and you say, what we didn't see last night. I just want to brush on this as well, because we're talking about confidence in US assets. The US 10-year auction last night went particularly well. Now, there was a lot of attention on it. We were some people thought there might be a buyer's strike in there, but like you said, China's not about to shoot itself in the foot. It holds a lot of US treasuries, and it's not about to just dump a load on the market or disappear in total. There was decent indirect bidding, which is again accounts that outside of the US that want to own treasury debt, and typically these are pension funds and everything else, I believe, if I'm right. And account for a foreign demand as well. And so that was telling that there wasn't any buyer's strike there. There was still maybe a hunger for US assets on that front. But like you say, all this chips away and potentially hurts the US moving forward as an investment tool or investment vehicle.
I think so. And I think, to be honest, the proof is in the pudding, as we often say. I think the price action in the next few days is going to be interesting. Right now, the dollar is pretty soft, which I'm not surprised. I think the market used this dollar rally to just sell dollars. I think there's just, this sort of bad taste left out there. And I personally don't think Trump can do anything to reinstate that anytime soon. Things will slow down, and it's going to be less crazy and so on and so on. But I think the overall damage is done. I think people will have. I think there's a second element. Yes, I know we don't want to be too political, but right now this is very close together. It's also what people start to worry in the investment form or in the business side is the way how let's say goalposts are being shifted, whatever way it suits. And that is just the worst for business. So it's not just a panic as such, but it's actually not knowing what's next. A business needs a strategy, a business needs a long-term outlook, a business needs rules, and rules that will be obeyed. You don't have that right now in the US. And I think that's an additional problem that they may face going forward. Unless sanity returns and some of the less qualified people are out of office, and people similar to Besant may make up the real brain of the operation.
No, interesting. We're running into the end of the show here, and so I just really want to recap. Thank you for that, Beat. It was, again, insightful as ever. Just to quickly recap then on, again, the primary reason for this show was that we had US CPI and inflation data out today. It's taken a back seat to what we've seen. The cash markets are going to be open stateside in about a couple of hours from now. And so we'll get a second round of, or a second dose of volatility, I suspect, as markets correct themselves again. Like you say, we had these wild oscillating swings one way or the other. But just to quickly recap then, we got US CPI today. Just to give you a note, just a different perspective from a different bank. This is from Rabobank in their note today. They say the US CPI inflation for March expected to show a fall in the headline inflation rate to 2.5% from 2.8%, and a modest decline in core inflation. Sorry, my wife ringing me at inopportune times. Negative base effects are still playing a role here, so decline in the year-on-year figures should be discounted somewhat. What it says, it should be discounted somewhat. What's more, the March CPI seems like old news, with the tariffs expected to push up inflation again in the coming months. At least it is likely to confirm that inflation did not get close to 2% even before the tariffs. So there's that dynamic there. Again, what is the long-term trend for inflation going to be? So again, looking through today, that's going to be a key question for many investors really to understand and get their head around. And listen, with that, again, Beat, I'd like to thank you very much for your contributions today. As I said, very insightful, and thank you very much. Anyone who wants to listen into today's inflation report, or just to take up a subscription, because I think in these times it wouldn't be a bad idea to have a squawk on at the moment, because you never know when these things come out of the blue. Beat, as you can testify. attest to rather. Try us out, livesquawk.com. See if it's something for you as a day trader or as an investor. And we'll be back for another episode in the very near future. Thank you very much for listening, guys. And stay safe in these wild markets. Have a good day. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.